So, hello everyone. It is with a great pleasure that I welcome you here to the 6th Sustainability Lunchtalk, this time dedicated to sustainable finance and more specifically to green investment funds. So before continuing, I would like to remind you that this WebEx event is recorded and will be made available in the next few days on the sustainability web pages of the university. So I am Laurent Bétry, I'm the Sustainability Officer of the University of Luxembourg. I'm responsible for integrating sustainability into the operations and functioning of the university. And one of the facets of my action is to raise the awareness of the university community on the different themes of sustainability. So the Sustainability Lunchtalk series developed with the University Sustainability Coordination and Expertise Group is intended for everyone, committed or not, and its main objective is to restore the facts in the mass of information that is about sustainability. So this is why we invite recognized researchers in the field to inform us in a short interactive format on the contribution of science to the issues that we want to address. And today we propose to address a subject that is relevant for Luxembourg, sustainable finance. As you know, the financial center is a major economic player for the Grand Duchy, both a major contributor to wealth creation and a provider of high-paying jobs. Luxembourg is known for its strategy of niche development and rapid adaptation of its public policies. And the emergence of sustainable finance has become a major challenge for Luxembourg, which aims to be a European and global reference in this area. Green bonds, ESG criteria, the European taxonomy, green finance, socially responsible investments are all terms that are used daily in the Luxembourg Financial Center to respond to the growing appetite for investors for investments that respect the environment and promote the ecological transition. What is the reality of this? Is the financial industry and particular investment funds up to the challenge? And how is it responding? To answer these questions, we have with us Professor Michel Halling, Professor of Finance at the University's Faculties of Law, Economics and Finance. He is the coordinator of the chair and of the research program in sustainable finance, co-funded by the Ministry of Finance and the Ministry of Environment, Climate and Sustainable Development. This webinar is hosted and moderated by Professor Sciardi Zanaj, Professor of Economics at the Faculty of Law, Economics and Finance. Her research focuses on fiscal competition and federalism, migration, cultural norms, gender, and the environment, for better understanding of interaction among states, strategic decision of companies, and decision-making of ethnically diverse groups. Professor Zanaj is also the Gender Equality Officer of the University of Luxembourg. So Sciardi, the floor is now yours.
Thank you very much. Thank you very much for organizing this event, a series of events, Laurent. And thank you very much for having me. So, as you mentioned, my beyond being a professor of the university, my other hat at the university is being the gender delegate, and as probably all the people participating in this talk, gender equality is among the available targets. But today we will focus primarily on the environment and the market for green investment funds, which probably, in a different event, we could make a link between gender equality environment as a target of sustainability. So let me tell you a few things before we start. So I will give a really short presentation of what is going to happen next in the talk of Michael, with questions actually that can already make the audience start thinking about what we are going to hear later in the presentation. I would like to tell you that so the talk of Michael will last between 30-35 minutes. You are free to ask your questions by writing them on the chat, and I will collect them and I will make them to Michael at the end of the talk. Unless there is some clarifying question that will allow you to better follow at that moment, for that question, then I will ask to stop to Michael and propose the question. So feel free at any time to write them on the chat. So the topic of today, the title of the talk today is the market for green investment funds. So what should you expect when you hear the market for a certain good or service is, of course, to hear about the demand and the supply. This is the two ingredients of the market, the most important ones. And immediately the first question that you should think about is, in this particular market that we will hear today, The demand is formulated, of course, at the last end of the chain by citizens, by consumers, by investors. How much environmental conscious and friendly are people, are the citizens, to formulate such a demand for green investment fund? Do we know that? So do we know how aware they are about their role in the transition, ecological transition? So there are several sources that tell us already about how extensive is this environmental awareness among consumers. For instance, just to mention one, Eurobarometer. This is a data base that collects periodically attitudes of European citizens. In one of the last editions, the Eurobarometer data tells us that 90%, 95% of the respondents agree with that using environmental friendly product is the right thing to do. Not only 91% agrees that buying environmental friendly products set a good example, and 80% of the participants agree that their family and friends would think it was a good thing if they used environmentally friendly products. So this tells us that at least in Europe, there is a massive percentage of citizens or consumers that are aware, and not only, but they see the consumption of environmental friendly goods as a moral thing to do, because their peers will change the way that they see them if they would choose environmental friendly products. So of course, the first thing you would ask is this only a European phenomenon, or is it only a Western world phenomenon, or is environmental awareness among consumers something that we should expect everywhere in the globe? The other thing is that I would like you already to start thinking is this environmental awareness among consumers or citizens is manifested in actual actions, in choosing actually buying greener goods or investing in investment funds, in green investment funds. And then on the other side of the market, for green investment funds, is the supply, is the financial industry at every level of aggregation that you can think of, at the market, at the country level, Luxembourg, as Laurent was mentioning, or broader, is the supply serving appropriately the demand? And now the financial markets are by definition an intermediary between consumers and firms. So naturally, the key question would be, is this functioning of this market impacting the polluter, the firms that will find the funds in the market for green funds? Are the green funds a multiplier, accelerator of this awareness of the consumers that will induce the firms to move towards greener products and greener technologies? So these are a few questions that I believe we will have several answers from Michael today. So with no further ado, I would like to give the floor to Michael for his presentation. And again, I want to remind you to write your questions in the chat. Thank you, Michael. The floor is yours.
Well, thank you very much, Skerdi, and thank you very much, Laurent, for excellent and well-fitting introductions. Thanks also for having me, and thanks to all of you for joining in for this event. So, as Skerdi already said, the broad theme of my presentation, my short presentation today, is about the market for green investment funds, which is actually a research project I'm working on together with a colleague at the University of Luxembourg, François Coulicher, and a colleague at a PhD student at the Copenhagen Business School, Andreas Broga. But I would like to actually put this project in a bit of a bigger, broader frame for the purpose of this presentation. Exactly as Skerdi put it, to basically reflect a little bit on the supply and the demand for sustainable finance or for sustainably oriented investment products. And before jumping right into the topic, maybe to define this term, which is sort of, or, define is maybe also a strong word, but at least to reflect on the meaning of the term sustainable finance, which is floating around very dominantly in Luxembourg and overall in general, is of course that we are basically, in sustainable finance, we care or we try to understand better the role of financial markets, very broadly speaking. So that can be asset managers, that can be investments made by individuals, that can be financial institutions such as banks, insurance companies. So everybody who's part of the financial market. So we're thinking about the role of financial markets in sort of fostering, enabling, stimulating, supporting the transition towards more sustainable societies. And so in that respect, all the topics in sustainable finance basically deal with this idea: how can financial markets help or contribute this transition? And in particular, for this talk, we're going to focus on asset management, the asset management industry, which of course is particularly relevant from a Luxembourgish context. But it's also relevant if you think about sort of to get you with it, into the talk. It's also relevant because it's going to be maybe one of the sources how you make your own investment decisions. So to some extent, I also would like you to think about, if you reflect on your own investment decisions, about how you can maybe support the transition through your investments. There's other ways how we can all be part of that transition, but through investments could be one of the mechanisms. And so that's another way of looking at the next 30 minutes, is to reflect a little bit about how can we invest in a sustainable way. What could be your potential preferences or motivations to do so? What has academia to say about this? And then what on the other side, what are the offerings that the asset management industry has come up with? And are we, so to speak, happy with those offerings, or is there something to maybe reflect upon? Maybe more can be done. So that's a little bit the broad outline of what we're going to talk about. And as Kerry said, obviously, please shoot any questions that you might have or that might come up into the chat, especially also if maybe some things are unclear, because obviously, finance sometimes has its own language, its own lingo. I'll try to be as clear as possible, but then, you never know. Sometimes if you've spent 20 years almost in that kind of field, some things become, common, which are maybe not as common actually as you might think they are. So the point that I would like you or the two main kind of topics or questions that we're going to reflect on is exactly as Kerry said. We're going to look at the demand for sustainable investment products or sustainable investments in general terms, and we're going to look at the supply. And so specifically, I would like to invite all of you to reflect a little bit about how you think about investing in a sustainable way, while I'm going to show you how academia thinks about the preferences of individual investors about social responsible investments. Okay, so I'm going to show you a couple of traditional classical ways about how research thinks about what kind of preferences could motivate investors to invest in a sustainable way. And I think the best, or it would be an interesting exercise to also see how you personally maybe reflect upon these preferences and what you think is a good match for you personally. And then given, starting out with these preferences, we're going to look a little bit into the asset management industry, the products they offer, kind of like what are green funds? What are they in a very broad context, but then also in the context of our research projects, how do we, for example, define green funds? To give you an idea a little bit how we think about this term or this sort of product. So here's an overview on the preferences that, at least from an economics point of view, are frequently distinguished in our research when we try to understand motivations for investors to invest in a sustainable way. And so what you have here, and maybe also one thing that I would like to clarify, right? There's also, of course, and we're not going to go into the details, but there's, of course, an important difference between being aware of the topic, right, and caring about the topic, and then reflecting it in your preferences, because here these preferences going to affect your choices, okay? And so it means that here, when I talk about these preferences, what it means is it's going to have real consequences on how you're going to make investment decisions and what kind of investment decisions are going to make you happy, okay? So it's going to have implications about how much your level of utility, that's how we would call it, or how happy you are, depends on, for example, the financial performance that you generate through an investment, and how much it depends on whether you invest in a specific sustainable or socially oriented way. So in that sense, these preferences are going to have real consequences affecting your decisions and affecting also how satisfied you are exposed with these decisions, okay? And so on the one extreme, there's a set of preferences that we distinguish in our research, which is called deontological preferences. And they go back to like the philosophical framework of Immanuel Kant, where it basically says that, there are some things that are right and some things that are wrong. And according to this kind of like compass, if you follow these preferences, then the wrong things you would never do. There's nothing that could incentivize you to engage in anything that you consider to be wrong. And so if you put this in the context of sustainability, then the ontological preferences means that if you consider certain investments that, for example, expose you to oil companies or fossil fuels, or, I'm going to show you a list of classical topics that would qualify for these kind of issues. If you have these kind of preferences, you would never invest in these firms. Okay, so if you have these strong preferences, for example, with respect to fossil fuel production, then you would never invest in an oil company, no matter what the price is. So even if the price of that oil company drops and drops and drops and drops, and it becomes cheaper and cheaper to invest in that company, there's no price at which you would be willing to invest because it's just wrong, according to your preferences, to invest in that company. That's one extreme. A little bit of a refined version of those preferences is what's called non-consequentialist preferences or value preferences, which means you're going to have strong values for certain things. So you're going to, for example, value renewable energy very highly, and you're going to disvalue, so to speak. You're not going to like fossil fuels or polluting technologies a lot. So you can think about, you get a warm glow, you get a good feeling if you invest in a renewable energy because you feel like you're investing in the right way according to your value preferences. And you would have a cold prickle if you ended up investing in an oil company in your portfolio. In this case, it's not 0-1, it's not binary, it's not you don't invest at all or you do invest. In this case, you can adjust a little bit your investment. And these preferences would mean that if oil companies at some point in time become attractive because their prices have dropped so much that their financial contribution to your well-being would be so big, then you would be willing to take it, even though you know it doesn't make you happy from a social preference point of view, but the financial performance, the financial contribution to your overall well-being would be large enough to compensate you to be willing to expose yourself to the cold prickle of investing in an oil company. Okay. At the same point in time, if you were to invest in the renewable energy, then you might be willing to give up some financial performance and still invest in that renewable energy company because it's going to create this warm glow. It's going to be, it fits well to your value preferences. So you're going to create some well-being, some good feelings, some utility out of being invested that is not reflected in the financial performance. It comes from something different from the financial performance. Now, the important part is also that in these preferences, you do not necessarily care about whether fossil fuel companies exist in the world or do not exist. That's what's called non-consequentialist. So in your case, you don't want to necessarily be invested in those companies, but you also don't have a mission to drive them away, like to basically remove them from the planet. You don't necessarily want to have a consequence with your investment. You just don't want to invest. You want to invest according to right and wrong in your perspective, but you don't necessarily want to change how right and wrong exists on the world. And if you add that dimension, then you're going to come to the third bucket here on the slide, which are consequentialist preferences. And in this case now, in some sense, these are the strongest preferences because now whether you feel good or bad about your investments does not only depend on your choice of particular investments, it also depends on the consequences of your investments. So whether you actually have an impact. So if you really, through your investments, if you make it, if you contribute to a removal, for example, or the disappearance of oil companies, or if you contribute to the growth and the stronger presence of renewable energy companies, then that's going to be part of your utility. So in this case, you care not just about your direct portfolio, you really care about the consequences of your portfolio, and you really would like to have an impact. And of course, having an impact is one of those terminologies that oftentimes pops up in a sustainable finance context. And so I think it's interesting to keep these three kind of types of preferences separate. Now, if you reflect on yourself and if you think about, what kind of preferences do I have? Let me give you some guidance about what economists have found in terms of the empirical evidence, or it's actually mostly experimental evidence on this. Obviously, it's not an easy task to elicit these preferences, right? Because as I said earlier, to really elicit preferences, you have to expose participants in an experiment to choices that actually matter to them, because otherwise it's not clear whether they have any incentives to tell you the truth about their preferences. So people ran different kinds of experiments, and of course we could have a long debate about advantages or disadvantages or how realistic they are. But it's very interesting to me, and that's not really my field. I'm only like a user of the evidence that comes out of those experiments. It was very interesting for me to learn that there's hardly any evidence about preferences that are consequentialist. So in all of these experiments, actually, investors would invest according to value preferences. So there's some notion about good and bad, and you would like to overinvest in good stuff and not invest as much in bad stuff. But investors usually, or in these experiments, investors never cared really about the consequences of their investments. And if you then dig a little bit deeper into the literature, it's actually interesting to see that there's a literature that is not necessarily related to sustainable finance, but it's related to the motivation for people to engage in donations or social projects overall, irrespective of the sustainability debate. And in that literature, people also found that actually the utility that people generate through donations comes from the act of donating rather than from the consequences that the donations in the end have. So people who donate seem to care less about what actually happens with the donation they did, but they enjoy and they create utility out of the act of donating. And so even in that kind of related but separate field, there seems to be some evidence that most preferences are value-oriented and not so much about having impact. Now, how is that now going to impact or reflect upon the supply side in terms of what the asset managers are actually offering to us as investors or to investors in general terms? Here you see a classification that comes from the UNPRI, so the United Nations Principles of Responsible Investment, which is a large supranational organization that is to some extent a bit of a, it's not setting explicit regulation, but it sets principles on a global scale to basically push the debate in certain directions. And they offer this classification about actually what do asset managers now offer to investors who have, who are interested in investing in a sustainable way. And what you see here is basically two broad groups. On the left side, you see asset management strategies. So basically strategies how asset managers put together or construct the portfolios that they then offer you to invest in that are based on screening approaches. And these approaches basically mean you look at potential investments and you collect data on these investments. Most frequently, you would collect ESG scores. So these are scores that data providers put together for many, many firms that measure how good a given firm performs with respect to environmental, so that's the E, social, that's the S, or governance aspects. And then the fund manager would say, okay, I, for example, exclude certain firms that have very, very low ESG scores, or I only invest in those firms that have the best ESG scores within their industries or compared to their peers. So all of these strategies on the left side, which are called screening here, take in these scores, use these scores to basically rank or sort the investment universe, and then either exclude the bad type firms or invest only in the best type firms. Okay, so this is one big group of investment strategies. Oftentimes, or a subset that is oftentimes referred to also in the media, is called exclusionary strategies because they usually exclude a lot of firms and basically try to reflect these sustainability preferences through the act, so to speak, of excluding, of limiting the universe that you can invest in. Now, if you think about these kinds of strategies, then they would be consistent on the demand side coming from the investors with these deontological or non-consequentialist preferences, because here the asset manager, so to speak, does not actively engage, for example, with the company to induce change. The only active choice that the asset manager does is actually reallocation of capital. So some firms will receive capital, other firms will not receive capital, or some firms will receive more capital and other firms will receive less capital. So this is basically, you try to reflect the value preferences of the investors that you have inside the portfolio by, for example, not investing in certain types of products. Now, on the right side of this slide, you see the other big group of asset management strategies in this area of sustainability, of social responsible investments. And these are all the investment strategies that are centering around the term engagement. I think even a more modern term nowadays would be stewardship. So that's everything where the asset manager actually says, okay, I'm going to actively engage with the companies that I'm investing in, and I will try to make them better companies. And engagement oftentimes means, you basically call up the board, you call up managers, You try to find alliances with other investors to basically raise issues. You do presentations at the annual shareholder meeting to bring up an issue. Could also involve that you basically try to vote actively on your share, because obviously here we're talking about equity investments. So all these investments are basically, you are the owner, in the end, the investor is the owner of the company, and so has some right to actually influence. Of course, it might be a small right if you only hold a small portion, but you basically, as an owner, of course, have the right to let your voice be heard at a meeting and to have an impact on some of these decisions. And so these engagement-based strategies would basically serve those investors that have consequentialist preferences, because here, that basically by investing in these firms, you also want to have a consequence through the investment, because you want to actively engage and actively transform these kind of companies. So this is just to give you an idea about the kind of like the sphere that you see in asset management. Now, in terms of size, like to give you a little bit of an overview on the market. So how big has the sustainable finance or sustainable investments market in asset management grown? On this slide, you see data from the Global Sustainable Investment Review from 2020. So it's not super recent, but relatively recent, and it shows you for Europe, the United States, Canada, Australasia, and Japan. So for these 5 regions, the growth in asset managers or in funds that basically follow one of these strategies that we have just described. So that basically engage or follow sustainability-oriented investment strategies. Okay. Of course, one has to be always careful, and that's where our research project comes into the picture a little bit later. That a lot of this data is self-reported, right? It's basically funds indicating that we invest in a sustainable way, and that's when they get counted in these numbers. And so what you see is that we're talking about serious numbers here, right? So in 2020, according to these classifications, in Europe, 10 trillion euros would have been invested in funds that follow one or the other socially responsible investment strategy. And almost $17 trillion were invested in US funds that had, that had similar, or that followed similar principles. So these are very substantial amounts invested in funds that follow these principles. You also see on the right side the numbers in percentage points and the bold numbers, growth rates over the years. And so you see that basically these kind of funds in the different geographies have grown dramatically. And I'm also going to show you a picture from our own calculations that there's been very large growth in these types of products. One thing that is interesting to highlight is you see in Europe, there was a negative growth rate in the most recent, at least in the data 2-year period from 2018 to 2020. And that's of course already giving you a hint. If you look at more recent data, where you get snippets already until like the end of 2022, you're going to see many more negative growth rates, because that's exactly where you see the impact of the current regulation trying to be cleaner and to be better in identifying truly green funds or sustainable funds, and basically getting a handle on this issue of greenwashing and funds arguing that they are green when they're not really green. So what you see is now that even self-classifications, again, Europe is a little bit leading here this debate. You also see it here. This corrective mechanism has already kicked in 2018 to 2020 in Europe, that more and more funds became a little bit more cautious in saying that they're green when maybe they are not as green as they might think they are, or at least they might pretend to be. But that's maybe something that we can also reflect upon a little bit later in the discussion. Now, in terms of the different strategies and how they and the different and sort of also relating back to our discussion about the different preferences. Here is data that is unfortunately a little bit older. It's for Europe. It's a European social responsible investment study from 2018. But I still wanted to include it to show you that the largest bar, the largest 2 bars at the bottom, the green and blue one, are for exclusions. So if you look at this universe of sustainable investments, then you're going to see that the large majority of the funds that are currently labeled to be sustainable basically follow exclusion. So that means they basically have a very simple approach towards the problem, in the sense that they just do not invest in certain types of firms. Okay, and so basically what you see here is that in terms of the supply of these funds, the large majority tailors to these deontological preferences, arguing that there's some types of firms, some types of industries that investors do not want to expose to, and these are excluded from the universe, And so there's basically they are you know, there's no way, there's no price, or there's no situation in which they could ever be included. They are basically mechanically excluded. And here you see the exclusions reach 10 trillion, or somewhere between 9 and 10 trillion in that sample period, and are larger by a large majority than any of the other strategies. So the exclusion approach really dominates. And to conclude this little market overview, before I give you in the last maybe 10 minutes a brief perspective on the research paper that we do. Here you see what are the classical or typical exclusions that are followed by most of these funds. You got, you know, controversial weapons, you got tobacco, you got gambling, you got nuclear energy, which is a very sensitive topic, especially now given that the taxonomy came out, in which nuclear energy together with gas have been identified as being transitional you know, energy sources. So these exclusions, for example, are currently hotly debated about whether they can, you know, whether they should be continued to be as prominent or common, or whether the taxonomy has actually changed some of these preferences. But that's just to give you a bit of a flavor about what are typical exclusions that we see here. Now, this was mostly, you know, in terms of, you know, introducing you a little bit to this notion of sustainable investments and looking at it from the demand or the supply side. Of course, there's a bigger issue in the topic of sustainable finance, and of course related to many of these dynamics that I've just shown to you. And I just wanted to throw them out to sort of show you a little bit also what academia and research at the University of Luxembourg, but of course also internationally, is currently thinking about in the area of sustainable finance. And so one key aspect is, of course, whether financial markets, including assets management, are actually able to fuel the transition towards more sustainable economies, right? I mean, that's the idea, that's the assumption, that's the plan. But I think we need to basically, you know, see how well it works, right? Because some of the clock is ticking. You know, we don't have hundreds of years left in order to kind of experiment with different mechanisms, but it's more like that we need something that works relatively in a short period of time. And of course, the alternative to that is that you would have to ask for more political intervention, right? To basically regulators and governments come into place and more severely intervene with our daily routines and our consumption patterns and other aspects of our daily lives to basically have an impact. And so that's the overarching big question, is about whether this mechanism through financial markets, through reallocation of capital, is actually something that really efficiently and effectively pushes this transition forwards. And that's a very difficult question, but it's one that gets quite a bit of attention. A related one, of course, is what's the role of these sustainable mutual funds? If you look at the pictures, at the 3-4 figures that I just showed you, it looks like amazing, no? I mean, there's like $17 trillion. It was like 15 trillion euros. If you add all of this up, it's like 13 trillion, whatever, euros, dollars that are somewhat invested in a sustainable way. That's a lot of cash, a lot of capital. Where you would expect, that's great. I mean, if all of that capital gets to use, then a lot of progress has to be made. But the question is whether that's really the case. And that's also where it feeds back into the different strategies, right? If half of that capital just excludes certain industries, the question is how big of an impact is it going to have? Because only a tiny fraction of that capital, for example, is invested in an active ownership strategy, in engagement strategies, where actually these investment managers really interact with the firms. And the other question, and the last one, which is in some sense a bit of a refined one, but all of these three are very related, and that's the one that I would like to reflect upon a little bit in the next 3 to 4 slides. Is actually, so we've seen this growth, we have seen the products that the asset management industry is offering. There's many different strategies, there's huge, enormous growth. But to what extent has the asset management actively adjusted? Like, how much has the asset management industry and have the funds really changed their allocations? How much have they really changed how they sort of invest capital? And that's exactly the question that we are targeting in this study that I mentioned earlier, and the study that basically gave the name to that presentation, together with Francois and Andreas, where we look at the global, basically the almost global universe of mutual funds. So we capture all of Europe and all of North America, and to dig in a little bit deeper into actually how green the industry has really become over the last 5 to 10 years. And in the last couple of minutes, I will just give you a flavor of that research project and a little bit of our main results. So I think I don't have to go into the details, but we use, for our purposes, classical traditional data sources. But to just give you an idea, what you're going to see, that the figures that I'm going to show to you are calculated in a bottom-up approach, which means that we have information on every investment that these funds had at any quarter during the sample period. So at every quarter, we know exactly every single investment that these funds have. And so we look into the funds, and then we look inside the fund to what are the firms that these funds are really investing in. And for now, we're concentrating on equity investments. So all of these funds are investing in equities. But we really know the individual firm that the fund is holding in a given quarter. And then we're going to try to see, okay, what kind of company is that? What is sort of how green is that company? And I'm going to explain in a second what I mean by green. And then we're going to take this firm level evidence on the greenness and we aggregate it up to the fund level. So just to give you this idea, this data is really big. Okay, so it's maybe not enormous, it's not huge, but it's a really big data set because again, it's like millions of positions that, we have more than 20, I think we have several thousand funds. They hold several thousand assets. And so every quarter, so it's a large data effort to put these things together. Now, another aspect in this debate, which is attracting a lot of attention, is, of course, what's a good measurement of how green something is? What's a good measurement about how sustainable something is? These ESG scores that I mentioned earlier have come a lot under criticism because they are basically a huge mix-up of a lot of things that have very little to do with each other. So you can have a high ESG score, appear to be a sustainable company, but for example, be very much polluting, have a very bad score on pollution, but you might be great on biodiversity, very social, take good care of human rights, take good care of the community, and so in the end still have a high ESG score. So the ESG score is a really difficult to interpret construct. So what we do is we look at pollutions data. So we collect and we use emissions data, and our whole analysis is about emissions. And so we call a fund to be green, then it's a fund that invests in firms that have low emissions. Okay, and so we don't use the ESG scores in that context. So as I said, it's a bottom-up approach. So we look at the individual firms that funds invest in. The measure that we care about is what's called carbon intensity. So that's tons of CO2 equivalent greenhouse gas emissions of a given firm, normalized by the $1 million of revenues. So it's a relative measure. So it tells you how efficiently, basically, how much or how little a firm emits in terms of pollution or in terms of greenhouse gas emissions per $1 million of revenues. So that's, I think that measure has a lot of interesting or attractive characteristics when you compare across firms. Of course, it has some disadvantages because a firm might appear to be emitting very little if it became very efficient. But if it at the same point in time grew a lot, in absolute numbers, it could still emit a lot of greenhouse gases because it was just growing. And this measure here is just on a per sales basis, right? And so in that sense, if the company grows, we would not capture that. And then we take this at the firm level and we just aggregate it up to green funds. And basically to the fund level to classify what's the average carbon intensity of a fund. And then we classify some funds to be green, which are those funds that have very little or that have a relatively small carbon intensity. And the threshold that we currently use is 60, which is a little bit arbitrary, but you can motivate in the literature that it's at least consistent with some of the transition paths in the Paris alignment to basically get down or get closer to net zero within until 2050. So I think I'm running out of time very quickly. So let me show you just a few figures and just illustrate a couple of things before I'm going to conclude, because I really would like to have some time to see your questions and reflect and discuss maybe how you think about these issues here. So here you just get an overview about the firm level data. And so you just see basically some information about basically low numbers of carbon intensity and high numbers of carbon intensity within different sectors. And I just show this to see how diverse the field is, right? If you look at utilities, materials, these are the classical industries that you would expect to be emitting a lot, but they are really emitting a lot, right? So they're like, so to speak, firms in these sectors that emit less emit between 200 and, let's say 230 and 400 tons per million sales, but it goes up to 2,000 tons per million sales. But if you look at financials or IT, then you have industries where these emission numbers are tiny, right? They're between 1 and 6 for the IT industry. And so you see that within, of course, industries or sectors, there's huge variation given the kind of profile that these that they have. Maybe in the interest of time, let me conclude by this one slide that I would like to show to you, because I would like to explain it a little bit. So this is now the fund level information. So we look at the global universe of funds in North America and Europe. We look at their individual holdings at any point in time, at any point, at any quarter, and we aggregate the emissions data that we have for the individual firms that these funds invest in to the fund level. And then we look at, okay, what does the fund universe look like? Okay. And so what you see here in the solid line, in the middle of the figure, so to speak, is what the statisticians calls the median. So that means if we sort all of these funds by their carbon intensity, we're going to take the one that comes out in the middle. Okay, so 50% of all the funds have a lower carbon intensity and 50% have a higher carbon intensity. And so what you see is in the beginning of our sample period for this median fund, the carbon intensity of its holdings was somewhere around 160 to 170 tons per million revenues. And over time, it has decreased. And I think that's the good news, right? So, given this development, the rise of sustainable finance, you see that the median has decreased. And at the end of our sample period in 2021, the first quarter, it has dropped almost to 100. Okay, so it came down from 160, 170 down to 100 for the median fund, which I think is a good observation. We would have expected to see that, and it's good that it also shows up in the data. What is maybe a little bit less comforting is that the distribution, and that's the gray shaded area around this solid line, is actually not shrinking much. And that means there's a huge variation. So there's still a lot of funds that have actually pretty terrible emissions data that actually invest in holdings, in individual firms that have very high emissions data. So if you look at the, at the top border of this gray shaded area, even towards the end, you are still above 150, 160 tons per million revenue. And that basically tells you that, there's some shift. So on average, the distribution of funds becomes greener, but there's still a large amount of capital invested in funds that do not appear to be green at all. So I have prepared a couple of more slides, but as I said earlier, I don't want to run out of time. That basically look into the size of these industries, and here you also see that also in our methodology, you see that a lot of more capital was flowing into what we call green funds. It's driven by Europe. Again, we knew that Europe is a little bit leading the pack in this debate. It's more active. It's, I think, as Gary said, it's maybe there's more awareness about the topic. The US has caught up a little bit in the last 2 years, but the wedge between Europe and the US has grown over time. So Europe is by far leading in terms of the offerings of green funds. What is a little bit the currently surprising result for us is that a large of that growth in these funds is actually not necessarily due to active reallocation decisions by management. A large part of that growth is actually that green investments earned higher returns. So over the last 2 or 3 years, or even 5 years, what you see if you look into the data is that green investments are also very profitable from a financial context. That's a very different question. We would need another seminar to explain that or to reflect on this in more detail. But what is a bit the implication for this figure is that it appears like that the industry has become much greener, but half of the effect that you see in this picture is not because the company, because the industry tried to become greener. It's just because any green investments that the industry already had, they just grew much faster because they are turned out being more profitable than the brown investments. So it just happened automatically that there is this big growth, and it's not because the industry is so much actively changing. So to conclude, I wanted to give you a little bit of an idea about sustainable finance and the kind of topics that we reflect upon in this area. Obviously, through our investment decisions, to all our investment decisions, we can have a contribution towards that transition. To what extent, how effective that contribution is, how large it is, that's a bit of a current debate in academic research. We're trying to figure out exactly what the best channels are, the best mechanisms. Should we support more active engagement, active ownership strategies? Should we move away from exclusionary strategies? These are all questions that somehow, that we talked upon. But it's also important to reflect on what investors actually want, right? I mean, what are the preferences of investors? Because obviously these investment products need to fulfill the expectations and the needs and the demand of the investors, because that's inherently linked. And so the funds cannot decide to do something what the investors do not want, because then the investors are going to withdraw their capital. And so hopefully some of these reflections turn out to be interesting. And now I'm looking forward to addressing some of the questions that you might have had. Thank you very much.
Thank you very much for this very interesting presentation. So yeah, thank you. I was going to ask if you can, so that we can see each other. So there are a few questions on the chat that I'll start saying you. So actually, there were already 3 questions that popped up at the moment that you showed the growth of investment in the green investment funds across countries. And there are 3 questions. 3 questions that are related are so. Is there a common definition across countries about the what is the sustainable investment, and of course how much we trust this self-declaration about of greenness, and are the criteria understood similarly? So how much do we trust across firms, but also how much do we trust the understanding of greenness across countries?
So the simple answer is that no, there's not a common understanding. So that's maybe one of the many challenges that we're currently facing. But there's multiple dimensions to the problem, right? So the first one is that there's not a common understanding about greenness. I think there's, I heard recently that I think overall, globally speaking, we have something around 70 taxonomies being in place or being developed. And so, we are obviously aware of the European taxonomy, but that's not a global standard. It's a European standard, which is, I think, not a bad start, but there's obviously many other debates. So no, it's not. Even within the European standard, right, there is a big debate about whether gas or nuclear power are green or not. And that, of course, is hard to answer. It depends a little bit on what is feasible, what are reachable goals. That, of course, neither nuclear nor gas are completely green is obvious. But then it depends a little bit on sort of different shades of grades, and of course, bringing in debates led by natural scientists about new technology. I think that's recently I heard presentations about this in the context of nuclear energy. So no, so I think that's there's no common definition. The self-reporting is of course a big issue, because the self-reporting also means that this data is not validated, right? It's not like financial information that gets audited in the end. And so, you have at least a reasonable amount of trust that the data is accurate. We don't have an auditing system for this ESG data. And so the only controlling or correcting mechanism would be, reputational considerations, would be issues about, NGOs or other players, pointing hand or pointing fingers to players that maybe do not follow along. Regulation in Europe has very much tightened. Right now, it's more people are commenting that a lot of asset managers might have funds that have good ambitions, but they are scared to label them as being funds that have an impact, because they're worried about being able to document the impact, because the data is not available. And then if they're not able to document the impact, the regulator is going to come back at them. And so now what you see is that there is, in terms of disclosure, there's this Article 6, 8, 9 funds. And we have, and Article 9 are those funds that actually commit to disclose how they have impact, so to document the impact that they have. So these will be the most ambitious funds that we should support. But you see a drastic decline in Article 9 funds, because the fund management companies argue, well, if we commit to that level of disclosure and then we're not able to deliver, we're going to be branded as being greenwashing, even though we tried hard, we did our best effort. So let's just not even try. We just go back to whatever Article 8, and that means we just follow some principles and we don't need to measure. So it's hard to make these things comparable. I think it's one of the big themes right now on the regulatory side as well as on the research side, is to make things more comparable.
Thank you. So I have some few questions that concern your paper directly. So one is, if you choose carbon intensity as one of your criteria, aren't you treating the service companies very differently from manufacturing industries, for instance?
Yes. So I think right now the idea or the sort of the direction would still be to say some of this notion that ultimately in this topic of carbon emissions, you need to have an absolute benchmark in mind, right? So we need to lower carbon emissions. So it's not only about relative comparisons, right? And so that's right. Financial services industry, service industry overall, will always show up as being green in these kind of considerations because they're just going to have very, very low emission intensities. But that still, I think, does not necessarily invalidate the approach, because what we need to figure out right now is I think what we really need to target is this tail of firms and funds that support these firms that have, an emission ratio of 2,000 tons per million sales or something like that. Because if you would find ways to incentivize those firms to improve, to lower their emissions, to change their products, to change their technologies, to in some sense reinvent themselves, it would have a big bang for the buck, right? It would have a big impact because these distributions are so skewed. And so, but that there are these sectoral problems when you then construct portfolios, I completely agree. That's something that in this context is almost unavoidable. That's a good point.
Thank you. So another question that is clarifying question is, in your paper, when you look into the emissions, is this net of the permits?
That's a good question. I have to admit. So that's a good point. I have to admit, I don't know. So we have to go to the provider, which is True Cost. I don't exactly know now off the top of my head how they collect the data. I have to admit that I'm also not an expert on those permissions and how broadly they use, right? So the universe here would be global firms. And I don't think that these permissions are, there's an active market on a global scale. But as I said earlier, I'm not an expert on these permission certificates trade. My understanding is that there were some tries in some regions to develop to establish these permits, and they were so successful. So I'm not exactly sure about the impact that they would have on the data. That's a good point. We would have to check actually. Thank you.
And another question that just arrived now that is an interesting one. So we are talking about emissions. But wouldn't it be another way would be to capture investments that are green investments by looking to increased resilience to the impact of the climate change as green? So a different.
No, I agree. So I mean, there's always this notion about, of course, addressing the problem to some extent through technological innovation, right? I guess this goes in the direction of carbon capture or other kind of technologies that maybe mitigate some of the negative consequences. So that would be interesting too. So I think there's one way to go into how much capital supports innovative technologies that help us solve the problem, and that I think is a little bit the focus of how does the allocation of capital respond to, let's say, the negative consequences, the pollution. And so in that sense, I think that would be another interesting measure to consider. I think it's one thing that we need to do in research much more is in general to have more targeted measures in the debate about sustainability and sustainable finance, because these broad ESG scores, I think, are not very useful, because there you have 70 dimensions and then nobody knows what's a good company and what's a bad company. Here, at least we can have this debate that we're just having, right? About that our paper right now focuses on the pollution side, but we do not currently consider measures about resilience or technological innovation in terms of capturing, which I agree. And so I think if we get aware of interesting data that we could use to sort of connect for a broad scale of firms, for example, to get information on how much they invest in these technologies or how active they are, then I think it would be very interesting to add that measure or to replicate what we did here with that measure. So in that sense, I think right now the emissions data is just is a specific data that is available in good quality, and I think, and it's relevant because it's the one that currently, of course, gets a lot of attention as well. So in that sense, it's that motivated our choice.
Mm-hmm. So I have a question that just arrived from Laurent. So do you think that the investment fund industry is responding well to the urgency that we are today?
That's a tricky one. So that's not. I think it's. So I think one important aspect, right, to say is anything that I said here is more is at the aggregate level, right? So about whether the industry overall, how much it is responding and well or not well. I think that's a bit tricky. I don't feel comfortable to make such a judgment right now. I think what I'm confident right now is that I think we should not be satisfied with the data that we see. So I think if we look at these aggregate statistics and say, hurrah, everything is great, there's now whatever $40 trillion that are invested in a sustainable way, and then everybody applauds and says, we're doing well. I think that's not correct. I think that we shouldn't do. That does not necessarily mean that anybody's doing anything wrong. I just think that these statistics or these representations, I think, are showing it as if there were too much going on. And I think that's something we first need to better understand the impact of that capital. At the same point in time, when I talk to some colleagues of mine at the University of Luxembourg who are more in the engineering departments, or when we had a panel on renewable energies, there you talk to people who have lots of ideas, innovative ideas, and say that it's not easy for them to get access to capital. So on one side, you get these statistics that there's $40 trillion invested somewhere in a sustainable way. At the same point in time, if you want to raise 2 million to explore an energy storage idea, you don't get the 2 million because there's no fund to sort of do that. I think that's a gap, that's a wedge that we need to address. And so here the point is more about that it's not clear that we have made so much progress as it sometimes might appear. But it's not. But I'm not blaming anybody right now. I think that's too early to judge.
Okay, so I think we are already out of time. I have a small question, Laurent, if you allow me, but we are already a minute over the time. So if I can go back to what you were saying at the very beginning, Michael. So I had the impression that you were saying that the supply of the industry is matching the preferences and therefore the demand, the type of demand of consumers. And I wanted to know, so could it be that the studies that have produced this type of preferences, that have proposed this type of preferences, are actually maybe based on data that comes from the behavior of consumers in the market, and given a supply, people are buying what is in the market. So is this really demand driven, or is it supply driven?
I think that's an interesting question. I don't have a good answer to that. I do think that that another overarching theme in this debate is potentially that sort of, is there enough pressure, so to speak, on, for example, asset managers to basically maybe offer more engagement-oriented products, right? Or is the demand also from our investor side, right? We as investors, what are we actually looking for, right? Another related question that we couldn't touch upon is, are we willing to give up some financial returns in order to, so to speak, save the world, simply speaking? Or is that not the case? Again, I could do another event about this doing well by doing good, which is very common in the industry, that you can earn more returns by investing in a social way, which is of course very attractive. That's a win-win situation. I don't need to convince anybody to invest in a social way because you're gonna earn higher returns. That's a no-brainer. But I think the reality is different, and that's also what academia would tell you, is that in the medium to long run, you would have to give up financial returns to change certain things and become more sustainable. But that's where then it becomes, these preferences really become important, right? Because what are these preferences, and are investors really willing to give up some financial performance in exchange for getting these social benefits of contributing? But I don't, I think we're too early. I mean, this is really what's currently investigated in research, and I don't have I don't even know if I have anything close to a definite answer on that one.
No, it was triggered by the fact that none of us appears to be like the person that care about the consequences. That's why I was.
Yeah. But that was also what I found when I looked into this literature, very surprising actually, and I think it has potentially important implications, given the considerations that how well are these identified. I agree with you. Maybe there's feedback cycles. Who knows? I completely agree.
Exactly. Yeah. Thanks a lot. So there is
someone.
There is someone that wants to speak. Alicia.
Hi. Sorry, no, it was an applause. I really appreciated the last question, which really shows that there's a lot of research still to be done to exactly evaluate for the demand to respond to the supply. Sorry, to respond to the demand, because we don't have that idea yet, and it seems that we're very new in that domain. So it was a really interesting question. That was all. Thank you.
Thank you. So I think we are already over the time. So I will give back the micro to Laurent. But thank you very much again, Miguel, for this very, very interesting talk today.
Thank you very much for having me. Thanks for all the questions.
Indeed, thank you, Michel and Skerdi, for this very informative webinar and insight on into the market for green investment funds. We have not yet covered sustainable finance, and I'm glad that we have finally covered this topic with you. Hope that you enjoyed, you all, the presentation and Q&A session. The recording of the talk will be made available on the sustainability pages of the university website in a few days. So it is now time to end the talk, but I would like to already invite you for the next Sustainability Lunch Talk that is scheduled on Wednesday, the 8th of March. Dr. Miguel Ecuija from the University of Mexico will join us to talk about biodiversity and ecosystems. So please visit also our intranet pages to see the program of the next talks, because one is scheduled in April, another one in June, and read the newsletters that my student assistant Moses and I have prepared on sustainability at the university. So I wish you all a very good afternoon, and I'm closing the talk by thanking again Professor Halling and Professor Zanaj for their excellent contribution. Goodbye.
Bye, everybody. Bye-bye. Have a nice afternoon.